Okay. And I'm pretty good the last couple of weeks in getting those recordings up. So if you do want to look at them, I'm providing the link on e-learning, and I'm putting it under the chapter appropriate. So you can find that under this one under chapter 4. Okay, good. Now, guys, I'm going to just quickly remind ourselves as to what the financial reports look like, focusing on governmental funds. Okay, that's where we're going to be spending our time. So we have the statement of net position, government-wide. We have the statement of net position. And then coming over, we have our, both the entire, I had to put it on 2 different slides. We have our net position. And then we have our statement of activities, government-wide, and where we're really going to be spending our time tonight is right here. Okay, looking at what? Looking at the government governmental activities, right? Using a program approach here, as you can see. And then we'll spend time really understanding the revenue recognition. Okay, what has to happen in order for, say, a property tax to be recognized on the statement of activities. Okay, and then we will also, okay, as we just saw, we have the program revenues towards the top of that statement of activities. These were our program revenues, right? We talked about this a couple times ago or last time. And then we have our general revenues, which we saw were down there at the bottom, right? Those general revenues. Okay, so I'm showing you the statements and then reminding you of some of the details there. Program revenue, there were 3: charge for service, operating grant, capital grants. Okay, so again, for our program revenue, charge for services, capital grants, and operating grants, not necessarily in that order. Okay. And then you can see we had the net expenses. Okay, right here, the net expenses, because those program revenues will defray some of the cost of the various programs, right? And then you come over and you can see that we had the taxes of all kinds down there on the lower section. I'm not going to flip back again. I think you saw that that was down at the bottom. Remember, I said it was sort of an upside down income statement. Okay. Now, when you look at the balance sheet, which is our governmental fund balance sheet, okay, remember we have the general fund, and these are all major funds here of different types. I guess maybe special revenue fund, looks like convention center bond, and maybe that's a debt service fund. I'm not sure exactly what this example is contemplating. Other governmental funds, remember, were the non-major funds, those that didn't meet those 10% test and 5% test that we talked about last time. Okay. And then you can see that we have our various fund balance categories that we talked about, non-spendable, et cetera. And then remember the reconciliation, which will show why there's a difference between fund balance for the governmental funds and the net position shown at the government-wide level for the statement of net position. We even looked at San Francisco's. And at the end of the night tonight, I'm going to statements in the reconciliation. At the end of the night tonight, I'm going to go through that reconciliation a little bit again. And we'll kind of visit that a few times because as we understand more about the nature of transactions, that reconciliation starts to make more and more sense to us. Okay. And then, and where we're going to be focusing our time tonight for modified accrual for the governmental funds is the accounting for revenues minus expenditures, right? Give us the difference is excess of revenue over expenditures, et cetera. And then remember, we had our non-operating section, which we said are primarily, we don't call it non-operating, but it's primarily, well, it's other financing sources and uses. Other financing uses are primarily transfers out. Other financing sources are primarily transfers into a fund and then the proceeds of long-term debt. Okay, but we're really going to be up here tonight. We'll deal with this stuff more when we get into 4B. Okay. Okay, good. So that's really what we're going to be focusing on, revenues versus expenditures, other financing sources and uses. We've already talked about the nature of those and how they affect fund balance. So I'm not going to repeat all of that. Okay, now when we take a look at the current financial resource measurement focus, remember we will only have current assets, current liabilities. We will not have long-term liabilities. We will not have long-term assets, right? Capital assets and whatnot, although they're reported at the government-wide level under full accrual, modified accrual, we will not be reporting those. Okay. Okay, good. Now, the way we're going to describe some of this is by showing the journal entries as though they were being entered using full accrual at the government-wide level versus if they were being entered under at the fund level using modified accrual accounting. Well, we've talked about that that's not really the way governments, including San Francisco, would do it. Most entries are made at the fund level. And then there's a process of adjusting entries, which will turn the modified accrual statements into full accrual statements. But we're going to sort of pretend like we're making entries at the government-wide level versus the fund level, just so the difference between the two and how they affect revenues and affect the financial statements at the different levels, how those transactions will, the journal entries will affect the appearance of those transactions on the financial reports. Okay, all right. Now, the first thing I'm going to do before we get into anything about, well, what happens if I collect a revenue beyond 60 days? How is that going to make a difference between the government-wide full accrual and the fund level using modified accrual? I'm just going to pretend that there is no difference in when these revenues are going to be collected and show you some basic things about revenue recognition, assuming that the revenues have met the criteria to be recorded both at the fund level and the government-wide level. After we go through this, then I will go ahead and start to show you some differences between the fund level and the government-wide level. Okay, so I'm showing you, hey, we would make the same entry if it was governmental activities or the using full accrual, fund level, say the general fund, using modified accrual. I'm assuming all of this stuff's going to be collected. We'll just stay within the fiscal year, whatever it is. Okay, let's just pretend for simplicity's sake, a calendar fiscal year starting January 1st to December 31st. That's kind of oxymoronic because you either have a fiscal or a calendar year, but calendar fiscal year, I'll say, beginning January 1st, December 31st. City, county, what are you, October 1st to September 30th? I should know that. Or are you July 1st to June 30th?
Yes, July 1 to June 30th.
July 1. Okay. So you mirror the state. Is that the reason for that?
Yeah, it's the same, is on the same. Yeah,
Yeah. Yeah.
but year, same fiscal year.
Yeah. Some counties will use the federal fiscal because federal fiscal starts October 1st and ends September 30th because maybe they get a significant amount of funding from the federal government. A lot of not-for-profits will use the federal fiscal year because of the amount of resources that are coming in. So it really depends on the business. For simplicity's sake, because sometimes it gets hard when you're trying to understand a concept and kind of squeeze it into a fiscal year that's being contemplated, I tend to try to say, okay, just pretend that it's a calendar year. Okay. So anyway, all the revenue we're assuming here is going to be that is collected will be collected within the current fiscal year, at least 60 days thereafter, so we don't have to worry about recognizing revenue at the fund level. Okay, so what happens? The government mails out tax bills. They'll put that in taxes receivable current. Okay, now receivables are a current asset. Remember, we only have current assets at the fund level, right? So receivables are current. That doesn't mean current asset. that means current, and that so far these tax bills, I'm going to assume property taxes, whatever, have not become delinquent. Okay, so the people are going to be potentially paying on time here. Okay, but we'll see what happens if they do start to become delinquent. But right now, we're just going to, okay, nothing has really been due yet, and so we're going to put it into current. So we debit taxes receivable, current. We credit revenue, but we credit the revenue net of the estimated uncollectability. Now you look at that and you say, well, John, that kind of sounds like a modified accrual rule, but if we're doing the same thing at the governmental activities at the government-wide level, why? And the issue there is GASB's looking at the nature of a transaction that is non-exchange. And if it's a non-exchange transaction, meaning it's taxes, and we're in a situation where folks are paying and then waiting for a service, you don't use a business type approach of setting up a bad debt expense like you would in business. In business, we would have booked the revenue gross and then set up an expense for our bad debt expense of this $5,000 and credited the allowance for 5,000 and debited the expense. And then we would have debited tax receivable 5 and credited the revenue 5. For the governmental funds, GASB says no, just reduce the revenue by the amount you think you're not going to collect. If we're dealing with the proprietary funds, okay, which potentially are providing a service and maybe doing some sort of billing process and whatnot, then we may use the bad debt expense. But for our governmental funds, we don't use bad debt expense. Carmen, do your enterprise funds set up bad debt expense? Like the water utility, for example, or water utilities?
Hmm, good question.
You don't have to answer that off the cuff. We can look that up later. Huh?
I want to say I think so. And we do something sort of similar too, but I would say probably yes. Yeah, I don't know. We might have somebody who knows more on the call if they want to pipe in, but
Okay.
yeah.
And we're not to the details of the proprietary funds yet, so I'm kind of maybe asking that question premature. I'm assuming, though I thought maybe I heard you're reducing the revenue by the amount you think you're not going to collect, right? Like this?
Yeah, but we have that little comment that said about the teeter fund. So that's a special little nuance where we we actually believe we'll collect everything. So yeah, it's a special thing. Not everybody does the teeter plan, but like we can get into that a little more too, if people want to. It's kind of unique though, so it's not going to be probably in the book.
Okay. Okay. Yeah, we can bring that in maybe when we do one of our guest speaker breakoffs or something. That might be interesting. Um, but anyway, so you can see here, GASB says, well, reduce the revenue by the amount you're not going to collect, and that's contemplating this transaction. Now, as we start to collect, of course, we'll debit cash, credit the tax receivable. Now, some folks will go into a delinquent status, unfortunately. They don't pay on time. They start to become delinquent. And so what you see at the top here, and again, it's both the same for the general fund and government-wide, we will reclass the receivable out of current by crediting the current, that's that remaining 50,000, and debit delinquent to reclass it into delinquent. Now, it is still a current asset, but now we're just saying these folks are late and we're putting a label of delinquent in there. And in this example, they're going ahead and setting up the allowance now, taking it out of the allowance delinquent by, excuse me, taking it out of the allowance current by debiting the allowance current and putting into allowance delinquent so that there's a match between the receivable and the allowance associated with that. Now, we can also set up amounts receivable now for interest and penalties. And so we're saying, hey, interest and penalties are going to be 500. And even the interest and penalties you may not collect. So you set up an allowance for that and record that interest revenue, interest and penalty revenue, and you report that net of the uncollectible amount. And the only difference between these two slides, this one dealing with modified accrual and the general fund here, is that you might have a different title for your revenue account at the government-wide level. And so they're just calling it general revenue. Remember, we're down there at the bottom of that statement of activities where we're calling out certain things as general revenues. Now, if there's a write-off, just like you would for commercial, okay, you go ahead and you debit the allowance when there's a write-off, you credit the receivable, which is the same thing you would do in commercial if you actually have to write something off. Question on any of that? Okay, now as we start to take a look, and guys, you may see a slight difference in the ordering of the slides. As I've mentioned, one of the annoying things of taking my class is I have to, for some reason, I have to tweak the slides all the way up until the last minute. So this slide may be a little bit further down. If you're following on your laptop or your tablet or something, you'll still find this slide. It just may not be in the same exact place. But when we're looking at our revenue recognition, and we're going to spend most of our time with non-exchange transaction. Non-exchange says what? Hey, you pay your taxes and you expect fire and police service to be there when, and if you know it, hopefully we won't need it. I don't know if any of you are in the Hayward East Bay area. We had a scary day. There's at least 3 different earthquakes during the day here. Not big ones or anything, but certainly a jolt that would get your mind thinking about public safety and what the fire service is doing if they're around. Nothing caught on fire or anything. It just all of a sudden feels like somebody's. Did any of you feel it? I don't know if you're anywhere where you could feel it. It's like like a truck backed into the house or something. It's just one of oh,
Yes.
okay.
The earthquake that's at 2 p.m. today, right?
There was one at 2, yeah. And there was also one at 2 just prior to 12 o'clock. And then I slept through it, but I heard there was one at 5 a.m. So in the last, 12 hours, we've had 4 different, and I'm assuming there's somewhere on there a Hayward fault anyway. Hayward's not famous for much. It's famous for, probably one of the more dangerous earthquake faults in all of at least the United States, if not all the world. So anyway, fortunately, we're on bedrock here. So I guess we tell ourselves that to lull ourselves into some sort of sense of false security. Bedrock tends to not, even though there's 2 things that cause an earthquake to be more destructive. One is the depth of the earthquake. The other, how deep in the ground it is. The other is the nature of the soil. So that's why Loma Prieta would hit the marina very hard, because a lot of that is on landfill, and I guess something called liquefaction takes over. It's like shaking a bottle of pills. You have a bottle of pills, it looks solid, and then you start to move it and everything moves. The way the landfill works, that's what they call liquefaction. If you're on bedrock, the violence of the shaking is not as tremendous. So anyway, more information than you needed on all that. In fact, I didn't think you needed any of that information. But anyway, so we have what? The 4 categories: non-exchange, you pay your taxes. You expect the government to be there when you need them. Now, when we look at non-exchange, okay, there's 4 categories. There are derived non-exchange, imposed non-exchange, government mandated non-exchange, and voluntary non-exchange. And depending on the category, we're going to see that GASB has given us certain criteria to use to decide whether or not the government should recognize that revenue and therefore report it. And we're going to talk about reporting it at the government-wide level, statement of activities, And at the fund level, say the general fund on the statement of revenues, expenditures, and changes in fund balance. Now, what happens as governments are to meet eligibility and time requirements in order to recognize something as a revenue generally across the categories. And eligibility means, is the government even entitled to that revenue? Now, for the derived and the imposed non-exchange, we're going to see that eligibility is not an issue. So anybody that's out there that's thinking, oh, I don't have to pay my income taxes. No, FASB said the government's entitled to your income taxes, so there's no eligibility issue, and you can go fight that one in court, and we'll see you in prison with people like Wesley Snipes and some others who have tried to fight that theory before. Okay, for the government mandated non-exchange and the voluntary non-exchange, yes, eligibility would be something that we'd have to consider. Although when I look at this, at the end of the day, I'm kind of like, eligibility is really only particularly relevant when it comes to voluntary non-exchange. Okay, government mandated non-exchange is where the state, let's say, comes down and says, you will do certain environmental procedures, certain environmental cleanups and whatnot. And we're not going to be, giving you an unfunded mandate. Here's the money to do what we're asking you to do. Now, some people say, well, the city, the county doesn't have to comply with that. Well, yes, you do. If you're a county within a state, it's legally respected that you will follow the mandates of the state that you are in. So I guess you could take them to court to fight that, but that's probably a losing battle. And so eligibility really is not much of an issue when it comes to government mandated. Voluntary non-exchange, yeah, finally eligibility really starts to become relevant in that you may have to meet certain criteria to even be eligible to be awarded some money. For example, HUD used to have programs where governments would apply for a certain amount of community development money, and there'd be a pot of community development money available or HUD, and they would take different proposals and would award money out until the pot was empty. Well, yeah, that's an obvious eligibility issue. And so we'll see where eligibility really starts to come into play for the voluntary non-exchange. So we're looking at these. Do you meet eligibility in time? If you do, you're a revenue. If you meet eligibility but not time, we call that a deferred inflow. Reported on the statement of deposition, reported on this balance sheet for our governmental funds, statement of deposition at the government-wide level, but it's not fully considered a liability, even though it's sort of right next to the liabilities, okay? And then if you have not met neither eligibility nor time, then you are officially considered a liability, and that would be reported on the balance sheet next to the deferred inflows, but you're not considered a deferred inflow. You were actually considered a liability, and you don't call it deferred revenue. You could call it unearned revenue. You could call it revenue collected in advance, but you can't use the D word. You can't call it deferred because FASB said, nah, we're saving that deferred word for deferred inflows. Okay, so I have this silly little graphic here just to sort of show the evolution from a revenue collected in advance, an unearned revenue, something that's reported as a liability because it has not met eligibility nor time. So it's sort of the caterpillar dreaming of being a butterfly, a revenue butterfly someday. And then as we go through this process, we go from what, hey, now we've met eligibility but not time. We are therefore a deferred inflow. We've got the little cocoon graphic there, okay? Forgive me for the silliness of this. And then once we have met both eligibility and time, then we become the revenue butterfly. We get reported what? We get reported on the statement of activities at the government-wide level, statement of revenues, expenditures, and change in fund balance at the fund level as a revenue, as we saw where some of those revenues were being reported at the bottom of the statement of activities, and in a more traditional income statement approach with the revenues at the top on our statement of revenues, expenditures, and changes in fund balance. Okay. All right, good. So we have the 4 categories. Okay. Now, the important thing in this slide, because it's a little bit repetitive, but that last bullet down there, we have the rules that we've seen as we've laid them out, eligibility and time. Okay. But for time, okay, for our modified accrual, as we've been discussing, not only do you have to meet the time requirement that's spelled out as to when the funds may be used and whatnot, but they also have to be collectible within 60 days of the fiscal year. And on my little example that I'll be using, the calendar year end. And those that fall outside of the 60 days, okay, so let's say we're talking about 2025, let's say the fiscal/calendar year end is December 31st, 2025, revenues that maybe would be collected in January, February, okay, but let's say something's not going to be collected until, I don't know, let's go all the way to April, just to not have to deal with leap years and whatnot. We'll say it's not going to be collected until April of 2026 in this example. That would be a revenue of 2026 because it fell outside of the 60 days under modified accrual at the fund level. Meanwhile, we would have included that as a revenue at the government-wide level because under full accrual accounting, we don't worry about that 60-day criteria. And so I'm going to show you some specific examples, and I think that'll solidify that rule for you a little bit more. Now, as we go through that difference in the rules a little bit more. Now, as we go through this chart, I think if you were going to earmark a particular, dog ear, a certain slide, this might be one because I happen to think it does a nice job of sort of saying, okay, these are the categories. These are examples of the type, okay, derived, imposed, etc. What is the requirement? And as I've already stated, time is relevant to all the categories. Eligibility is only relevant to government mandated and voluntary non-exchange. And then they tell us, well, what will trigger the recognition of the revenue under these different categories? The top part is accrual, and then we have this note at the bottom that says, and by the way, keep in mind that 60-day criteria, again, it's not written in standard that it's 60 days, but many governments and a lot of literature uses 60 days criteria. And apparently that's what the city has been evolving to. And so I think it's relevant for our purposes too. Okay. All right, good. So let's go ahead and talk about derived. Okay. Now, when we say derived, the issue derived is the revenue is derived from some underlying transaction. For example, sales tax is a derived non-exchange because the underlying is the sale. There's a sale, we tax the sale, and that generates the revenue for the government. But the thing that caused that revenue for the government was what? Was the sale that the sales taxes were generated off of. Income taxes. There was income, there's the tax. Okay, gasoline tax, whatever. Okay, now if you notice here, going back to sort of my little cheat slide here, if you will, what happens? They say, well, you recognize the revenue when the underlying transaction takes place. So if the sale took place in 2025, we recognize the revenue in 2025 on that. Pretty simple, right? Okay. If the income was a 2025 income, then we take the revenue based on what we believe our 2025 income levels were, and so forth. Now, that's the accrual rule. Modified accrual, we've got to kind of be a little more careful and say, well, yeah, but will we collect those taxes within the 60 days in order to conclude it as a revenue of, in this example, 2025? Because if it starts to go into, again, say March 2026, and then it hasn't met the modified accrual. Yeah, January 26, yeah, it could still be 25 revenue. February 26, yeah, it could still be 25 revenue. Starts to go too far into March, and I'm going to go what I said all the way to April. Then no, that's going to be 2026 revenue because it's gone beyond the 60 days. Okay, and we'll look at how that works with some of these other categories here in a minute. Okay, and so again, I'm calling out, yeah, modified accrual when the underlying transaction takes place with the 60 days. We don't worry about the 60 days for full accrual. It's when the underlying transaction occurs. Okay. So this is an example, I think, that I don't know. Sometimes I look at this example and I'm like, was it maybe a little overkill? But I think hang with me, okay? And it'll kind of be worth it here once you spend a little bit of time with it, okay? So we have the sales taxes. I'm assuming, again, a calendar year, okay? So the first quarter is January, February, March, and so forth. And this government collects the sales taxes in the next quarter, okay? So the reason NA is up there for the first quarter is they would be getting money in that was for the previous year, and so we're not going to consider that here, right? So you get your first quarter money in the second quarter, that's when it's collected. Okay. Now you take the 46,000 of sales. I'm using this 6.25 tax rate. Okay. And so we have 2,875 for accrual. The transaction took place and say this is 2025, we'll say the first quarter. So it's revenue of 2025 for accrual purposes. Now, for modified accrual, you sit there and you say, well, are we going to collect it within 60 days of the year? And if we're getting it in that second quarter, yeah, we can put that as collected in the modified accrual, and we'll go ahead and include that as revenue for 2025 in my little example here, right? And so forth, guys. We keep doing that. And notice everything that happens in the calendar year, okay, for accrual purposes comes over and is going to be recognized as revenue. Now notice that what at 12/31, okay, we set up a taxes receivable of 1,313 and a revenue of 1,313. And you're looking and saying, well, John, if they're not going to collect that until January and they're not going to collect that all the way down here until March, how do they know what the amount is? And as you guys well know, there would take some time before we would have to issue these reports. Maybe we're issuing our financial statements in, say, February, March or so, and by then we would know how much we had actually collected. And even if we didn't know, we'd have to estimate how much we think we're going to collect. And so we'd be able to debit the receivable and credit the revenue. The important thing here, the key takeaway, is notice that for modified accrual, everything for full accrual, everything gets recognized because the underlying transaction took place during this calendar/fiscal year. For modified accrual, what happens? Yeah, we know that we collected this 1113, and we know that we collected it within the 60-day period because we got it in January. So it's what, 31 days at the most, right? When you look at the 200, since that fell outside of the 60 days, we don't have to worry about eligibility for derived revenue like a sales tax. We do need to worry about time. And since it went outside the 60 days, it is a deferred inflow. Okay. And so if, let's say I was asking you a question, we'll look at some examples of some questions later tonight. I may very well say to you, well, what would be the revenue under accrual? What would be the revenue under modified accrual? And you would have to know that 60-day criteria essentially to know the difference. Question. Okay, good. Now, let's take a look at imposed non-exchange. And the example here is property taxes. Don't need to worry about eligibility. Do need to worry about time. Okay. And they tell us that we can recognize the revenue when use may begin, okay? Or the government has a legally enforceable claim. That's more relevant to fines and penalties than property taxes. With property taxes, often what a government will say is, hey, even though you may levy the tax prior to the year that the taxes are to be used for, even though you may collect the taxes prior to the year that the taxes are to be used for, you can't recognize it as revenue until you are in the year that the monies are to be used for, or those funds aren't to be used until you're in that year. So when use may begin. Now, what I want to do, I forgot to open it, is show you an example. Let's see. What's the best way for me to find this? Let me try it this way. I forgot to open it. Sorry, guys. I had it open earlier. Okay, good. And I know that might be a little bit hard to see on your screen, so you may need to kind of, I don't know if you're aware that you can make the screen as big as you want. So I recommend you squeeze the the tiles here where you're seeing everybody's names, push that sort of to the right, and that'll make this thing a little bit bigger. I do it the opposite. I have two computers. I have the one you're seeing here that I'm working with. You can't see it necessarily. Okay, here it is. And then I have the monitor. I do it the other way. I squeeze my screen that I'm sharing with you, I squeeze it all the way to the left because I have what I need in front of me and I want to be able to see you guys. You may want to do the opposite, at least for this example, okay? And forgive me for the years on this. I come up with an example and I'm just too lazy to keep updating the years as the years go by, but it would still be the material, still relevant to what we're talking about here. So you can see here, and forgive me, I use City of Hayward, my hometown, right? City of Hayward mails out tax bills for $2 million on November 7th, 2018 to levy taxes for 29 activities. Okay, now they tell us that use of funds may begin in 2019. Now, we don't need to worry about eligibility here. So we go ahead and we debit taxes receivable that were mailed out 2 million. We credit the deferred inflow because we're not in 2019 yet. And so use may not begin with this money until 2019. Now, notice that the receivable and the deferred inflow are the same, both at the government-wide level and at the fund level. So I set up a receivable for us, both at government-wide and general fund. I'm not going to deal with taxes here. I mean, excuse me, cash here. I do have taxes receivable set up here, and it's the same for both as the money comes in. It doesn't matter whether I'm dealing with modified accrual at the fund level or modified accrual at the fund level or full accrual at the government-wide level. Now, when I look at this, I set up a deferred inflow government-wide, and then I have a deferred inflow at the fund level, and I'm assuming the general fund, okay? Because those will be different depending on how this money comes in. Now, what happens? We come to 12/1, 2018. So we're still in 2018. Use may not begin in this example until 2019. So when the money comes in, we debit the cash, we credit the receivable. And that's why we set up the receivable, because, we needed to know, well, what should we apply the money to when it comes in? What's it for? So we set that receivable up, we debit cash. I'm not doing a cash account to account here, so forgive me for that. And now I'm still expecting to see 1.9 million. Some folks will pay their property taxes near the end of the year because they want to deduct it on their income tax, right? Okay, so that wouldn't be unusual for that to happen. Now, what happens? We come over and when we hit 2019, January 1st, 2019, now use may begin. The time requirement has been met at the government-wide level, we go ahead and we debit deferred inflow, we credit revenue. Okay, so we take the entire revenue at that point in time. So we debit the deferred inflow. Our revenue is now 0. This is at the government-wide level. And so when you take a look at the revenue now, where's my revenue ledger? Government-wide, there's my credit to revenue for the 2 million. So I just went ahead and took all the revenue for government-wide, governmental activities, okay? As a practical matter, what I'm doing here is I'm saying, well, for the general fund, I'm not going to take all that as revenue because I'm stuck worrying about that 60-day criteria. So as a practical matter, what I'm going to do is put this government on a diet, if you will, of recognizing the revenue as it comes in so that if something slips outside the 60 days, I know to include it in the next fiscal year, which I guess in this little example would be 2020. Okay. Now, at this point, this, is all about, okay, what are we going to do in the general fund as stuff gets collected? Okay. So what happens? I get this $1 million on April 12th, whatever. Okay. So what do? I debit the cash. Again, I'm not accounting for cash. I credit the tax receivable. Okay. My tax is receivable. And again, that tax is receivable now would be the same for both the government-wide and the general fund. Debit cash, government-wide, cash, general fund, credit the receivable. So now I'm still expecting 900,000 to come in. And for my revenue account at the fund level, now I go ahead, debit deferred inflow, and I credit the revenue. Okay, and so you start to look at my revenue ledger for my 2019 revenue at the general fund level. There's that. And notice the debit here to the deferred inflow. And I'm just sort of looking to see when is the money going to come in. Remember, deferred inflow is on the balance sheet. Revenue, butterfly, gets to get off the balance sheet and go into the income statement. I mean, yeah, the statement of revenues, expenditures, and fund balance, which is our whole focus here, revenue recognition, right? Okay, then you go ahead and some more comes in. Same thing, debit the cash, credit the receivable. Okay, looking over at my receivable ledger. Okay, I'm still expecting another 100,000 to come in. And I can go ahead and take the revenue, debit deferred inflow, credit the revenue. So my 2019 revenue now for my general fund is starting to pop up, right? Now you come over and this next, we got what? If I look at the receivable balance, I still got 75,000 left to go here for my receivable. Okay, or excuse me, I have 100,000 left to go for my receivable, and 75,000 of that comes in. And notice for that 75,000, it comes in, and I'm kind of pretending, okay, well, let's say that happened in January. We're still within the 60 days. So what do? I debit the deferred inflow and I still credit revenue, 2019 revenue, because even though it came in after the fiscal year, it still met the 60-day criteria. So I go ahead and I will take the revenue here and I'm up to 1,975,000. That's what I have collected up to this point. I'm still waiting for what? For 25,000. And I think you can probably figure out what this is going, right? 25,000 now comes in, and it doesn't come in until my little example here on March 20th. Now I'm assuming, hey, we're outside the 60 days. We're not able to count this as a revenue for, it's already in the revenue government-wide, but for the fund level in our general fund, it's outside of 60 days. It is not a revenue of 2019. It's going to be a revenue of 2020. So I go ahead and again, I debit cash, I credit the receivable. Of course, this is assuming that no more receivables were booked after that initial one, which would be unrealistic, but I just want to show you the impact. The receivable is 0 here now. I go ahead and I can debit the cash. I debit the deferred inflow for the 25. now I can credit the revenue for the 25. Here it is. Okay. But look there, it's 2020 revenue. That's 2020 revenue. So I don't enter that into the 2019 revenue ledger. I put that in what? In the 2020 revenue ledger, that 25,000. So if I says to you, well, what would be the revenue, for this kind of a situation under full accrual answers 2 million, under modified accrual, it'd be 1,975,000. Carmen, are you there? She might have to step away. Does anyone know, does a city take an approach of recognizing revenue under modified accrual as it is collected? Okay. Look, there's nothing I don't know. I can't bring that to the specific of the city situation. I don't work for the city, so I don't know. Okay. But this is an example of how a government might do it. Okay. All right, good. Let's go ahead then and let's move on, since I'm not getting a high level of interest in any of this material anyway. So we might as well roll through it, right? Get out early. Now, that would be my imposed non-exchange, right? When use may begin. Okay. And in that little example, I said when use may begin. And it was when use may begin, was in that example 2019. And even though they mailed the tax bills out in 2018 and whatnot, it didn't matter. It was when use may begin. Okay. Now, okay, so that's the example there of imposed. Okay. And we saw that detailed example. So let's look at a couple potential, and we'll see some more during the practice exam tonight, assuming we get to that. And we take a look, and we have City of Hayward has the following information. Okay, you see City of Hayward, you can figure that I probably put together that question. And it says property taxes collected in 2014 to cover 2014 activities. Now, in questions, by the way, that I give you, or if you're taking some, kind of exam dealing with governmental accounting, I do think it's worth looking at what we call the call of the question to understand, where are they asking me to report this? Is it at the fund level or the government-wide level? Some questions will say, hey, in the fund financial statements, in the general fund, and special revenue fund, the capital project fund, what we know, hey, modified accrual, 60-day criteria. Here, I simply said the statement of revenues, expenditures, and change in fund balance. So you would need to know, well, that's the name of the statement at the fund level. If it said statement of activities, then I'd use the full accrual rules. But since it says that, I know I need to consider collectability here as part of my time requirements, right? So I look and I say, okay, property taxes collected during 2014 for 2014 activities. So use may begin. So I'm going to go ahead and pick up that 600,000. Okay. Tax bills mailed out to be collected by January 2015. Yeah, I'm going to get that. That's using the 60 days. That's falling within the 60 days using the 60-day criteria. February 28th. Okay. Yep, that's 58 days. Even if it was a leap year, it'd be 59 days. So we'd be okay there. And so now we're looking at this last one, 317, and that's outside the 60 days. We wouldn't include that as revenue because we wouldn't collect it in time. So you go ahead and you do the math on that, and the answer would be what? This 1.1. And then I just went ahead and sort of showed you the journal entry down here. Yeah, you debit the receivable. The 400,000 that's going to fall outside the 60 days is a deferred inflow. The rest is going to be, revenue. Now, if I said statement of activities on this question, then the answer would be what? The entire 1.5 million. And this ignores the issue of, hey, do we even consider it collectible? Because remember, if there was an amount that we didn't even think we would collect, that would be credited into the allowance, and there would be, that would be credited into the allowance. Yeah, we would reduce the revenue by the amount we think we're not ultimately, that we're never going to collect. Okay, good. More of a theoretical questions. Assets such as property tax receivable associated with unavailable revenue, such as property taxes collected more than 60 days. What do we do with those? We treat those as deferred inflow. Okay. All right, so hopefully those examples would be useful, getting you to understand, how you might be tested on something like this, but also now you can kind of look at, say, the statement of activities, the statement of revenues, expenditures, and fund balance. When you see property taxes down there, or you see a different number for, revenue at the government-wide level versus the fund level, you can say, okay, probably that 60-day thing is kicking in. Okay. Now, if we're dealing about fines, remember, we're still in the imposed category. And the imposed says, the government says, send me this much money, right? Property taxes, if you have a house, times whatever percentage, send me that money. They send you a bill and you better pay it, right? Fines, hey, you better pay it, right? Now, with fines, though, maybe you're sitting there and you're saying, I didn't do this. I shouldn't have to pay this fine. So if that's the case, okay, then if it's disputed, the government will have to wait until it has a legally enforceable claim before it should recognize this revenue. Now, as a practical matter, what most governments do is they go ahead and just recognize fines and penalties, okay, when the person pays the fine. Because if you pay the fine, that's pretty much an admission of guilt, okay? What was interesting, I was on an assignment. I guess it's interesting. Maybe it's not interesting. I'll tell you it's interesting so that you think it's interesting. Okay. So the I was looking at US Forest Service, and what happens sometimes in some of these rural areas, you may have like farmers and whatnot that will do a controlled burn on their property to burn off, some excess crops or weeds or whatever it is they don't want. Maybe not excess crops, but, some land is unkempt. I mean, what they should do is hire those goats. I don't know if you've ever seen those you'll look up a side of a hill and there's nothing but goats sitting up there. And somebody has, brought them in to eat down all the foliage, which is probably a better way of doing it. But back in the 90s, what they would do is they would burn some of that, and they try to control the burn so it only burns the part they want to burn. Well, what happens is sometimes, as you might imagine, the fire will jump, and it'll jump into US Forest Service territory. And now you're burning good US Forest Service property, good, board feet of lumber that the Forest Service could auction off to a forestry company, a wood company, right? What they do is they go and they'll just auction off they take the highest bid and they auction off a whole parcel, and then the lumberjacks come in and take that, and they take it to market and they sell it and they make a profit off of that. So if that gets burned, that's a cost to the federal government. That's a loss to the federal government. So what the federal government would do is they would bill the person that they had believed set the fire, maybe through a controlled burn, not arson, but it's an accident, but still you're responsible, right? So they were booking revenues for those, receivables and revenues for those. And I looked, and in some of the cases of the sample of transactions we looked at, the person that was being fined was still disputing that they were the ones that started the fire. And so we had a finding there and asked for a correction in the Forest Service financial reports to say, you can't take this as a receivable and as a revenue because you don't have a legally enforceable claim yet. So the federal rules were very similar in that case, although the federal rules at that time were still emerging. And so I was looking more towards other standard setters like GASB and like FASB that had, hey, have you really met true revenue recognition through analogy? Because the federal statutes weren't quite to that level yet. And I used to annoy not only the people I was auditing, but also my colleagues when I would come up with findings like this. But ultimately, we asked the Forest Service to make an adjustment for that because they didn't have a legally enforceable claim. So as a practical matter, the government has to have a legally enforceable claim. And what most governments will do, because it doesn't materially affect the financial statements, is say, we'll just wait until the fine is paid. Okay, and that's how we'll go ahead and put down the correct amount of revenue for this. Okay, so when you look at this example, you see this, the dreaded parking violation, right? And what happens? There was one part of the penalty that comes in upon discovery. Once the meter worker goes ahead and recognizes that there's a violation, they come up, they see the little violation thing in there. I'm going old school. It used to be this little tab that would sheet metal tab that would pop up and say violation. Now it probably would do it electronically. But hey, you violated, boom, that's $100. Okay. Then there's a $50 additional that comes on for every hour that the vehicle sits illegally sitting in that parking spot. So what happened? The person that was getting this ticket, the violator, I guess we'll call them, they accepted, yeah, okay, I was there, but I moved it within the hour, so I'm disputing the $50. So the revenue would only be what? The 100, because they collected the fine. The person didn't dispute that. The part that's being disputed, you would not take the revenue for that until the person is adjudicated responsible for that additional hour or whatever it is. As a practical matter, these days, particularly with the electronic meters and whatnot, it's going to pretty much matriculate to when the amounts are paid, take the revenue. It's almost like a cash basis approach there. Question? Comment? Any of you deal with? I know we've had a couple parking ticket questions that I've asked. Okay. Okay, good. Non-exchange fees like driver's license. Okay, it's a fee, but it's still considered non-exchange because it's not quite the quid pro quo. You give me this, I give you that. And so pretty much, when the person comes in to renew their license, that's when you'll go ahead and take the revenue for that. Okay, so dealing with licenses here, I did another little example here with the city of Hayward. And there's this 870,000 in business taxes. And they mail the bills out in November for 870,000. They collect 300,000 of it before 2014 is even out. But notice what allows the entities to do business in the city in 2015. So that becomes what? That's when use may begin. That is a 2015 number amount of revenue. So for 2014, it would be zero. It would not become revenue until what? Until 2015 in this example, when we've actually entered the year covered by the licenses. This is a variation. I could probably get rid of that other one. This one I took from CPA review material. And that, again, similarly, hey, they're collecting money and whatnot in year one, but it's for year two activities. Okay. And so how much is revenue in year one? Answer is what? Nothing. It's all deferred inflow in year one in this example. Okay, good. Government mandated non-exchange. And this is when the higher level of government comes in and tells the lower level of government, okay, I'll deal with the mandated first, okay, tells the lower level of government, hey, you have to do something, okay? And so we see that recognize revenue until all time and now eligibility is talked about by GASB as being something we have to consider for mandated. And I'm like, well, I don't quite, you know, see why eligibility is that relevant for mandated when what are you going to do? Tell them no, you're not going to do it. This higher, I'm looking up because it's higher level government, you're going to do it, and they're giving you the funding for it. And so eligibility really isn't as much an issue. Time, though, I'm going to give you an example where time would come in. For voluntary, yeah, then eligibility really starts to become interesting. Now, where I could see eligibility becoming relevant, if you will, I mean, GASB tells us it was relevant. Come on, John. Oh, forget it. I'll circle the voluntary rather than change the color. FASB tells us that it's relevant for mandated, okay, because if it is a reimbursement type grant, in other words, you're not eligible for this money until you spend the money, then yeah, but then it sort of would even skip deferred inflow because once I've spent the money, I debit expenditure, let's say I credit cash, I've spent the money, I've met the eligibility, and I'm assuming there's no time issue there if I've already spent the money, then I would simply do what? I would simply debit, say, grant receivable or, mandated grants, whatever receivable, and I would credit the revenue at that point because I've already spent that cash. Debit expenditure, credit the cash, debit the receivable, credit the revenue, and it doesn't even stop at the deferred inflow. So I guess eligibility for mandated could come in there. For voluntary, yeah, eligibility, I have to be first told that I've been basically awarded this thing that I voluntarily asked for some money from this higher level of government, say the federal government. Okay, so again, if you have a reimbursement situation that I just kind of outlined there, then yeah, I could see eligibility being relevant for a mandated. Voluntary, yeah, then we get into eligibility quite a bit more. And I'm going to give you an example of through a problem of how we might navigate through eligibility and time in the case of a voluntary non-exchange. Okay. Now, for the mandate, okay, this is basically saying intergovernmental, higher level of government tells a lower level of government, hey, you have to do this, and here's the money to do it. Well, when should you recognize the revenue for that? Okay. And by the way, I'm looking down here. When we were talking about standards, okay, in 2015 is a little dated, but I think they have a new one out now. But the AICPA does put out auditing and accounting guides that I didn't mention when we were talking about standards in some of our earlier chapters that may be useful. I don't know if Carmen was able to hear us again, but um, do you have these guides available? AICPA auditing and accounting guides for state and local governments, because they do provide some useful stuff. Okay. Okay. So what happens is you take a look. Change the page a bit, let me. I don't understand why PowerPoint has such a rudimentary pen palette when Word has something much more useful and they're the same company. But anyway, okay. So what happens? Let's say I'm sitting here and I have a county. Okay. And for the county, okay, the year goes from January, and be ready for questions, guys. The year goes from January 1 through December 31. So calendar year, fiscal year, just for simplicity's sake. Okay, and that's the county's financial reporting period, right? Calendar year. Now, for the state, let's say the state starts its fiscal year in June. Not probably not June, but July. Ugh. July 1. Okay, and let's say that goes to June 30th of that next year. Let's say this is all a period 2025. Okay, and this goes all the way till June, from July 25 to June 26. All right. Okay. Now, let's say the state gives some funding to the county in July and says, you are to use that money in the state's fiscal year. They give them $1 million. Now, the county is going to use that $1 million, and they're going to use it July, August, September, October, November, December of 25, January of 26, February 26, because they're still within the state's fiscal year. So they're still within the requirements of what the state is saying. But some of that money's getting used in what? In the next fiscal year, 26 of the county. So here's the question. How much of that $1 million should they recognize as 2025 revenue? Go ahead, take a wild guess. Okay, I'll tell you what I'm going to do. I'm going to go ahead and leave that question on the table for you. Go ahead and take a look at it. Okay, and let's go ahead and adjourn for tonight, because I don't want to feel like I'm torturing you. Okay, so take a little time, take a look at some of this stuff. Okay, and what we'll do is we'll pick this up dealing with the second part of chapter 4 next time. Okay. And so we'll go through 4B, and I'll let you kind of review this stuff on your own, because I just don't want to feel like, this is, I'm not exactly sure why I'm recording it either. So I'm going to stop recording these too and give you a little time to just sort of look on this, do a little self-study stuff I think might be helpful for you. And what we'll do is we'll pick up the ball with 4B material on next Thursday. Okay. Okay, guys, have a good rest of the
Oh, I have
night.
a question about
Yeah.
this question. So the state says that the county uh, is eligible to spend the money starting July 1st.
Well, it's not really an eligibility requirement. It's a time requirement. The fact that the state is mandating and providing the money checks the ticket on eligibility. So we're on time, and they're saying the time when you should use the money would be during the state's fiscal year from July 1st, 2025. They give them the $1 million, use it during the state's fiscal year as you see fit. And what I'm saying is that, this county in this example, probably wouldn't use all the money in that 6-month period between January 1st and December 31st. They'd probably use some of it in January 26th, February 26th, and so forth. Does that answer your question? So I'm asking how much of this $1 million would be revenue in 25?
And okay, and then we'll answer it in terms of how, like the portion of the money that the county spend. Like if
Well, I'm not telling you how much they spent in
um
the question in 25 or 26. I'm simply saying they got the money in 25.
Mhm.
They have to spend it during the state's fiscal year, which began July 1st, 25, when they got the money. But they can still spend it in all the way up and through June 26, because they have to spend it within the state's fiscal year, that particular fiscal year.
Okay.
So I'm going to go ahead and okay, let's say I tell you, I can tell you. Let's say I tell you, okay, they spent 500,000 in 2025. Let's say I add that into the question. They spent that money in 500,000 in 2025. What should be the 2025 revenue? And then I give you some choices. 0, 500,000, a million, insufficient data to answer the question are my choices. A, B, C, D. A million, I tell you they spent 500,000. So would you say 0, 500,000, a million, none of the above?
500,000.
Good. Thank you for jumping in on that. That would be your instinct, but as a practical matter, they would go ahead and take the whole million as revenue in 2025 because they got the money and they had met eligibility and time that they just simply had to spend it within the state's fiscal year. Now, you're kind of feeling there is, well, wait a minute, because they really didn't meet the time requirement. We didn't know that they met the time requirement until June of 2026, and they would almost certainly meet that requirement because they don't want to turn the money back to the state. But as a practical matter, since these mandatory grants tend to come down in tranches that are fairly even over the years, it really doesn't matter because they'd get another million in July, and even though of 26, and even though some of that money would shift over into, 27 use, they'd count that all in 26. So it'll be fairly consistent from year to year. So once you meet the eligibility because they're telling you you have to, do something and they're giving you the money. And once they give you the money and tell you you use it in the state's fiscal year, it doesn't matter. As long as you use it in the state's fiscal year, you can take that revenue because you're going to earn it and use it appropriately within the state's fiscal year. Okay. Okay, good. You guys want to keep going or you want to end here? It's your class.
Can I ask, like, it said will be applied to both modified accrual or full accrual?
The only thing with modified accrual here would be collectability, right? So they've already given me the money. So the 60 days is neither here nor there because they've given me the money here, right? They've given me the $1 million in this fiscal year. So I'm not worried about, hey, am I going to collect it within 60 days? And so there's really, as a practical matter, no difference between the modified accrual and the full accrual. Okay.
So starting July 1st, 2025, they can immediately recognize the 1 million as a revenue. Because they
Yes.
need eligibility and time.
Yes, because eligibility is really not an issue when you're considering they're telling you to do something and they're giving you the money to do it. And So then you start to say, well, what about time? And I could use the whole million in July. I could use it all in July, and I'd be meeting the time requirement using within the state's fiscal year. And we don't start getting into parsing. Well, how much did you use in your fiscal year to hit your financial statement? You had the money. You had to do something. They gave you the money. Eligibility is checked. Time, they told you could use it within the state's fiscal year, and part of the state's fiscal year fell in the county's fiscal year. So we just say take the whole million because you're meeting the time requirement because you're now in that fiscal year of the state, and that fiscal year of the state contemplated year started in the county's fiscal year. So take the full million, even though you may spend some of that amount in the next fiscal year. And Gatsby's okay with this approach because their rationale was, well, look, you're probably going to get another million or so in um, July 26, and some of that will go into fiscal 27. And so it doesn't make a material difference as you go from year to year. So just do it this way. Okay.
Okay.
All right. So
thank you.
let's do this. Let's look at this example in which we have a voluntary non-exchange example. And again, I took this from my CPA review material. And again, guys, I recommend you make your screen bigger so you can see this. But we say that this community college received 900,000 multi-year research search grant available for use on a prorated basis over the next 3 years. Ding, time requirement. Next 3 years, 300,000 a year. Okay. And it is also subject to other enrollment-based eligibility requirements. At the year end, at year one of the grant, at the end of year one of the grant, the college had achieved enrollment levels to satisfy amounts up to 500,000. As a result, the community college would recognize, and they want to say, how much revenue do you have here? How much deferred inflow do you have because you've met eligibility, but not time? And how much unearned revenue do you have because you haven't met neither eligibility nor time? Now, when I look at this solution, I kind of look at it like this. I say, well, look, for me, the easy part is they got this 900,000. And they've met eligibility for 5. So I know there's an unearned amount of 400,000 because if you haven't met eligibility, it's a liability. Okay. For example, and the reason it's liability, definition of liability for GASB and FASB says, hey, if there's a chance that you will have to sacrifice an asset, that's a liability. And if you don't ever meet the eligibility, you're gonna have to give them that money back, aren't you? Okay, so that's 400,000. That is an unearned revenue. We don't call it deferred revenue. We can call it revenue collected in advance. We can call it unearned revenue. Okay, now how much is revenue though? Of this 400,000, how much is revenue? And you can kind of look at the solution down here. Well, if it's 900,000 of which I'm only supposed to use a third a year, use it over a 3-year period, then 300,000 is revenue. Okay. So if I look at that and I say, well, look, 300,000 is revenue. I've met what? I've met eligibility for 5. I've only met time for 3. Then that means what? That means the remaining 200,000 must be what? Must be this deferred inflow amount. Okay. So that's an example, voluntary non-exchange. We're finally what? eligibility does become relevant, and then we layered a time requirement on top of that. If I simply had to meet enrollment levels and there wasn't any time on this, then I would have taken that entire 500,000 from revenue into revenue. And sometimes that's what happens with these voluntary non-exchange, or even if it's a mandate, if you have to spend the money first, we just jump over deferred inflow and go straight into revenue. Okay, charge for services pretty much recognize the revenue when the service is provided. Okay, and this slide, as I've mentioned, is a good little cheat sheet that if you're looking at questions or something, you may want to have this close by hand to kind of help you remember some things. Okay, so that's that. Let me go ahead and let's put up some potential questions here. Okay. And see how, we might want to test some of this. So, number one, under the accrual basis of accounting, imposed non-exchange revenues such as fines should be recognized. And we saw that from the lecture slides when the government has a legally enforceable claim, right? I mean, that's pretty much right off the slides. And I gave that little example of the Forest Service not having a legally enforceable claim and not being able to recognize the revenue for that. Okay, as a practical matter, most governments would probably just say, hey, we collected the fine, take the revenue. That's pretty much an admission that we have a legally enforceable claim. Number two, under the modified accrual basis of accounting, imposed non-exchange, such as fines, should be recognized when the government has a legally enforceable claim and when collection within the current period or soon enough thereafter is used to pay liabilities of the current period. That's for modified accrual. I probably should have pointed out there. And that's the phraseology that GASB uses that translates into, for our purposes, what? The 60 days. It's available to pay liabilities of the government within a reasonable period of time, which many governments have, defined as 60 days. Number three, under the modified accrual basis of accounting, license fees, permits, miscellaneous revenues, even though I don't know why this is D, has these weird letters, but anyway, when cash is received, yeah, pretty much is the way they do it as a practical matter. And that, once somebody comes in and pays for the license, you can go ahead and take that revenue. Where we start getting a little more interesting in these couple questions here, you can see that the city sits here and it has a 12/31 fiscal/calendar year end and has adopted a policy of recognizing the maximum amount of property tax revenue allowable under GAAP. Guys, that's somewhat of a weird phraseology trying to get you into thinking that the 60 days is required by GAAP. It is not. It is not required by GAAP, but most entities use 60 days. So again, for our purposes, let's always use 60 days. Just keep that in our head as the 60 days is the criteria for modified accrual. Okay. Now in this problem though, it's important that we talk about what? We're talking government-wide statements here. Okay, so property taxes of 720, of which 90% are estimated to be uncollectible, are levied in October 2013 to finance activities of the fiscal year 2014. During 2014, cash collections related to property taxes levied in October 2013 were 6. In October, collection in October 2013 was 600,000. In 2015 were some weird spacing. January was 30. March was 6,000. For fiscal year ended 12/31/14, what should we put in the government wide? Now, let me ask you a question. Does the collectability, the time of collection matter for our government wide?
No.
Does not matter. So this information, very good, is irrelevant to answer this question, right? However, even though I will debit taxes receivable, 720,000, I will only take into revenue what? And the quick way to answer this would be to say the 720 times what? Times 0.9, if they tell me 10% are not collectible. And so the revenue on that, the correct answer to this is going to be what? 648,000. And the credit that I need here, what's the amount of credit I need, John? 48, what's
72,000.
72K.
72,000? Thank you. The 72,000 is going to be what? That's going to be the allowance.
Allowance.
Yep. Okay. Now, when you look at the next question, same facts, but now I'm asking about governmental funds. So now what? Now the 60 days matters, doesn't it? Okay. So now I have to kind of sit here and look as to, well, and the way I would do this, just let's just look to see when they collect the money. So 600,000 is coming in 2013. So certainly it's coming within 60 days of because it's for 2014. So that's going to be within 60 days of 2014 because we're counting the 60 days after 2014, 60 days within 2015. In 2015, what happens? 30,000 comes in January. Yep, that's 60 days. The what? The 6,000 doesn't come until March. We're considering that outside the 60 days. And so that gives me what? 630,000 as the answer. Now, sometimes students will say, well, what about the uncollectible amount? Well, the uncollectible amount will never be considered revenue. We put that in the allowance, right? That's never going to be considered revenue. And we only look to the 600 that we collected in advance of the year. So it's in, when we count the 60 days, it's 60 days, what? After the fiscal year, right? They were looking for that 60 days. So it's within that 60 days for the 30,000, but not the 6,000.
I have a question. Is there a typo in the year? Because we jump in between 15, 14, 13.
No, I don't think so. They levied the taxes in 2013, right? That's when the bills went out. So when the bills went out in 2013, they would debit taxes receivable 720. This is 2013. We credit, and in 2013 is deferred inflow. For the, what is it, 648? And then there'd be that allowance amount of 72, right? For the amount we think we're not going to collect. And then when we get to 2014, at the government-wide level, we can go ahead and take that whole amount by debiting, I'm going to abbreviate a little bit here, deferred inflow, the 648, and take the, this is 2014 now. I mean, yeah, 2014. Debit the deferred inflow and credit, this is government-wide, and credit the revenue, right? Thus the answer to that first question up there. How much is revenue in 2014? And then in 2015, the third year contemplated in this question, that's 2014. Oh, wait, let me stop. 2014 at the fund level, say the general fund, it's as we collect it, right? So in 20, yeah, 14, we would go ahead, and I'm not worrying about cash here. We would go ahead at that point and debit deferred inflow for just the 600,000, because now we know that we got that within the 60 days, correct? The revenue is 600,000. Now, even though, and that's 2014 revenue. Now, even though now I'm in 2015, for that amount in January, the 30,000, I would debit deferred inflow for the 30,000. And I would still have my 2014 revenue ledger open. So 2014 revenue, I would credit that 30,000, and that's okay because I'm not issuing the financial statements probably till, a couple months after the fiscal year. And then and for the March, that 30,000, right, which is 2015, when that finally comes in, I mean, not 30,000, but what was it? 6,000. For that 6,000, then I'd go ahead, debit the deferred inflow now for that remaining 6 and credit revenue, but it's what? That's 2015 revenue for 6. Now, where were you seeing the typo potentially, or did that answer the question?
Yeah, yeah, thank you. I think so then in order just to understand, the deferred inflow will span years and it will fit for the governmental funds then. So right now we're talking about, so you showed us 14, 15. It's really like that, right? It's spanning and then it's reducing.
Yeah,
Um,
the deferred inflow, right? Let's look at that deferred inflow as a T account. Okay, so initially, even though I was just doing it for government wide up there, it was 648. Right, and then if you count the debits, 600,000, that was 2014 revenue. What was the next amount? 30,000?
mhm.
Did I do this right? What am I doing wrong? Now it's not going to add up for some reason. The 30,000 that came in January, that's 2014 revenue. And then the 6,000 that came in that I debited there. Again, now my problem's going to be exasperated by the fact that I can't write. I'll write it up here. That's 6,000. That's 2015, right? Revenue. Now my question is, there's what? So it's there's still a little bit left over here. How much is left? 648 minus 636.
12,000.
How much?
Is it 12,000?
Let me do it. 648 minus what? What are we saying? 636? Is 12,000, right?
Yeah.
That 12,000, I can't tell you from this problem when they're going to collect it. Maybe they get it in April. Maybe they get it in May. I don't know when they collect it, but I can tell you is, and if they collect it, if they don't collect it, then they're gonna have to take it out of deferred inflow and put it into and basically take it out of deferred inflow and by debiting deferred inflow and
Yeah, I think my confusion came from the fact that usually the secured role, if it's not collected, it goes to delinquent, so they write it off. So that's why for me, I was not familiar that the deferred
Okay.
inflow really spent the year.
But
I
I'm
thought
not,
we just, yeah,
I'm
that's
not,
why.
wait, stop,
Mhm,
stop. I'll let you finish in a minute. We're not talking about the balance sheet. You're starting to get into
mhm.
balance sheet write-offs and whatnot. This is the income statement, right?
Deferred inflow, is it on the income statement? Deferred
Oh,
inflow
that's
is
true. Deferred inflow is on the balance
a
sheet.
balance sheet.
That's correct. But the write-off is a whole nother process dealing with the allowance and the tax receivable, right?
Mhm.
If I write this off, I would debit the allowance and credit the receivable, right?
Mhm.
So I'm thinking if this thing and goes and there's some amounts that we don't collect that we had set up in deferred inflow. Because we're saying, well, we're not going to collect it, so it's no longer deferred inflow. So I have to debit deferred inflow. I'm guessing I would then, it makes sense, credit the allowance to put that in the allowance. And then I would write it off because presumably there was nothing in the allowance for that amount because I thought I was going to collect it when I put it in deferred inflow, right? The 648. So for that part that may be remaining in deferred inflow that I never collected and I want to write it off, I would go ahead and uh, debit deferred inflow, credit the allowance, and then write it off by debiting the allowance and crediting the receivable, right? In other words, taxes receivable. Come on.
Or maybe they can do AR delinquent, but yeah.
Well, yeah, I mean, don't get me into, also classifying it as delinquent. I'll assume it's delinquent since it's taking so long for them to pay it, but taxes receivable, right? In this example, still would have had a balance of 12,000 that hadn't been collected because they've told us they've collected the rest, and I don't want to go through the whole story. There's still 12,000 hanging out there, right?
Mhm.
On this. And so now they say, you know what? These people are not going to pay that 12,000. I want to write it off. Okay. So what I'm saying at that point, the process would, because theoretically, it's right here. You'd still have a balance, right? I'm going to just do a balance column over here of 12,000, right? So at that point, since that's the balance, my pen won't write in the margin over there, but that's the balance right there where I'm kind of there. Just let me circle it anyway. That's the balance is the 12,000. So what I'm saying is debit deferred inflow for 12. That clears that out. That's now zero balance. Credit the allowance. Put it into the allowance because you're saying, hey, these people aren't going to pay. And I'll just, just so everything kind of balances out, no pun intended, I'll just go ahead and say the allowance now has 12,000 in it, right? Ignoring any other amounts that might be in there for other things. And so now I have the tax receivable of 12, I have the allowance of 12. So now just debit the allowance 12 and credit the tax receivable for 12, right? It's all cleared away now. I wrote it off, but I had to get it out of deferred inflow because deferred inflow is a balance sheet account in which you're saying, I'm expecting this to go into revenue at some point. And, it doesn't go into revenue for the modified accrual statements until I actually collect it. Now, for full accrual, you're saying, well, what's going on with full accrual? Well, the way to look at an allowance really for anything, an allowance is an estimate account. I'm doing it in this sort of static one transaction kind of trip, but the allowance, you're putting amounts in as you make assessments as time, your collectability changes. If the economy isn't doing as well, remember we looked at the management discussion, economic outlook. Economy isn't doing as well. So you start to say, oh, maybe I'm not going to collect as much on this. You put more in the allowance. Things improve, you don't have to put as much in the allowance. Allowance is a fluid estimating process. I don't know if any of you are involved in that, as to how you think you're going to collect, and you put amounts into the allowance accordingly. And so if you felt, well, look, I need more in the allowance because I had taken revenue in a previous period for something that I ended up not collecting and having to write off. Now I'm talking about at the government-wide level. So what? FASB calls that change in accounting. GASB and FASB call that change in accounting estimate. And change in accounting estimate says, hey, you don't go back and fix. You just move forward with the new estimate, trying to hit the right target as necessary. I'm talking government-wide now at this point. For the fund level, something like this would happen because hey, I didn't collect it. It's probably never going to get off into the revenue butterfly. Let me take it out of deferred inflow. But even that is probably somewhat of an estimating process.
Okay, thank you.
Okay, good. We're coming up on time, I see, guys. And so that's good, though. I think we had a good discussion. I appreciate the questions. So here's what we're going to do. We're going to pick up on next Thursday with number 6 here. We'll go through this. We'll jump into the slides for chapter 4B. And so that's the approach. I think you're kind of starting to get the feel, the rhythm of the class. Go through the slides. When we can, we go back and look at the annual comprehensive financial report for some examples. We go to the practice exam, and then we'll be ready to take this exam together on whatever the date that's on the syllabus. Okay. All right, guys. Have a good evening.
Thank you.
Thank you,
Thank
John.
you. Thank you.
Thank you,
Thank you.
John.
Thank you, Professor John.
Good night.
Bye-bye.